Wow, what a year to be the investment speaker. For the past 5 years, we've been celebrating. It seemed like there could be no end to how high prices could go or to investor appetites. And every year we asked ourselves, have we reached the top of the market yet? In 2007, it started off looking just like 2005 and 6. It was a great first half. But in just a few short months, the market turned from a bull market going into 2007 to a bear market at the end of 2007. So, what are the factors that created this dramatic change? The housing market slowdown and the meltdown of the subprime loan industry had a far-reaching impact on commercial investment. Going into 2007, we were in the midst of the most aggressive lending environment in 15 years. However, by the third quarter, CMBS lenders, who made a whopping 50 to 60% of all commercial loans, suddenly were out of the market. Without this huge lending source, the investment sales market faltered. Add to that concerns surrounding Indiana real estate taxes, a slowing economy, and the fact that 2008 is an election year, and what resulted was investor uncertainty that caused buyers and sellers to end the year by sitting out on the sidelines. Let's take a look to see how each of the market segments fared in 2007. In the office market, nearly a third of all multi-tenant office inventory changed hands between 2005 and 6. That's a lot of volume, so we already expected the number of transactions in 2007 to be less, and it was. We recorded just 14 major office transactions, totaling $197 million in 2007. Sales volumes were down, but the office market still recorded some mega deals, like Woodfield Crossing, Landmark Center, and the Quads. Looking forward to 2008, the number one factor for office is job growth. And where job growth goes, office investment will follow. Class A buildings in strong submarkets like Carmel, the Northwest, and Keystone will continue to attract investors. In contrast, Class B and C office product will be perceived as carrying greater risk and will be more difficult to finance. The typical Class B and C buyer is a leveraged buyer, so we would not be surprised to see cap rates increasing 50 to 100 basis points as a result of increased financing cost. Now, in the multifamily market, we recorded 29 major transactions totaling $347 million in 2007. About the same number of transactions as in 2006, but only half the dollar volume. Big sales, such as Coppertree and Lakeshore, still got done in 2007, but what about next year? The multifamily market is uniquely positioned to benefit from the housing market slowdown. Expect rents to increase and occupancies to remain high, as would-be home buyers stay in apartments for the foreseeable future. In addition, multifamily assets will be less affected by the credit crunch due to the availability of financing from banks and from Fannie Mae. This will make multifamily transactions easier to complete for leveraged buyers. Okay, so I've just told you office and multifamily sales volumes were both down, but 2007 was a banner year for retail sales. We tracked 25 major retail transactions totaling $200 million, double the volume of retail sales last year, and the largest retail sales volume we have ever tracked for a single year. What a contrast to the other property types. The reason? Retail sellers like American National, Duke, and PK Partners all sold early in 2007 while the market was still hot. For retail next year, investors will be focused on the overall health of the economy. Indianapolis seems to be oversupplied with unanchored retail strip centers, creating a concern that there are not enough tenants to fill each of them. In a slowing economy, investors will be cautious about investing in these smaller unanchored centers. On the flip side, investors continue to seek recession-proof, institutional quality retail in secondary markets like Indianapolis. Well-positioned centers here of $15 million or more will be highly sought after in 2008 by institutions and funds and even some TICs which have cash to spend. So what about industrial? Sales of significant industrial properties in 2007 came in above 2006 levels, with 21 transactions totaling $264 million and 6.4 million square feet. The year started off great with a very active first half, but it slowed considerably with the onset of the credit crunch. Sellers pulled several major deals from the market and held off listing new properties during the fourth quarter. Almost half of the total square feet sold came from these 5 top transactions. Institutional buyers love Indianapolis industrial property, especially ones located in controlled submarkets like Park 100 and Park Fletcher. And these investors are expected to be very active in 2008. In fact, more industrial deals are slated to close in the first half of 2008 than in all of 2007. But while deals will be getting done, it may be at slightly lower prices. Expect to see higher cap rates of 25 to 50 basis points built into 2008 industrial transactions. Now, for our overall predictions. If you're a potential seller, the good news is that investors have huge amounts of capital they need to invest. This will drive the investment market in 2008. However, expect a flight to quality, as buyers will favor less risky properties, which are easier to finance. Investors will use less aggressive assumptions for growth and for vacancy, and to only underwrite the income that's currently in place. With both lenders and buyers implementing more conservative underwriting, some pricing correction is likely. 2008 will mark the return to a more normal investment market. And by normal, I mean underwriting that's backed up by the property fundamentals and not by the capital markets. While this may disappoint some owners, it is a more favorable environment for buyers. In summary, it's a new year, and it is a somewhat different reality. But we have confidence in the resilience and creativity of the investor, which is the key to success in the commercial investment market in 2008.